was much higher.
Good afternoon and welcome once again to Inclusive Finance India Summit 2021, organized by Axis and Axis Assist and co-hosted by Niti Aayog. I'd like to thank each one of you for joining us this afternoon for a technical session titled Digitalization in Lending, Analyzing Social and Business Impact. This session is being hosted with our partner, CRIF Highmark, which is India's leading provider of credit information, business information, analytics, scoring, credit management, and decision solutions. It is my privilege to introduce the panelists for our today's session. Mr. Wilfred Sigler, Director, Sales and Marketing, CRIF India. Mr. Ajay Sahasrabuddhe, Chief Operating Officer, Retail Finance, Hero FinCorp. Mr. Ranjan Das, Chief Risk Officer, Arohan Financial Services. Mr. Vishal Wadhwa, Executive Vice President, Fullerton India Credit Company Limited. We have our lead presenter for our today's session, Mr. Vipul Jain, Head of Products, CRIF Highmark. And the session will be moderated by Ms. Sucharita Mukherjee, CEO, KaleidoFin. We are grateful to the speakers for agreeing to our request to join this discussion. And I'm positive that we'll be able to take away some key and concrete forward-looking recommendations for action. Welcome once again, and I now hand over the session to our lead presenter, Mr. Vipul Jain, to present his, to please carry on with the presentation. Sure. Thank you.
Thanks, Kirti. Thanks, Kirti, for the introduction. Hi, everyone. Hi, ladies and gentlemen. Just give me a minute. I'll put this on. Are you able to view the presentation?
Yes, Vipul.
Brilliant. All right. So what is interesting is, this discourse is something that we've been having for last couple of years around the impact of digitization, what it means for the borrowers, what it means for the lenders. What we've done here is looked at what the data pans out, and we followed it up with our own. First, we had our hypothesis through our observations of the ecosystem, looked at the data to see what the data indicates, followed that up with our discussion with the lenders, who are representative of this behavior. And what we have put together is to kind of touch upon what our observations have been and what has been validated by the entire lending ecosystem. Just a sec. Yeah, through this presentation, we are going to talk about, how big is this opportunity and what has been the impacts that we are already seeing unfolding. What we see as the shift in the demand from tier 1 market to, the tier 2, tier 3, and even in the rural geographies, what has been the impact of digital. We will look at it from the lender's perspective. We are calling it disruption in personal loan market because the kind of shifts that we are seeing, it qualifies to be called disruption. And, I'm going to talk about why we say so. Similarly, what is the disruption that we are seeing in the consumer loan market or the consumer durable market? What are the trends in the two-wheeler market, rural microfinance? What are the shifts? We have experts on the panel who are doing substantial business in all these products, and they have stakes there. And the trends in cross-sell that we are seeing in microfinance, which is significant. What the CRIF experience is what our observations have been across these products and across these markets. So, digital, we have been talking about what has enabled this. So, apart from what is there on the slides in terms of the numbers of what we were as a country digitally and what we are today, and why this kind of shift is being observed is because simplistically put, this is the hardware and the software both are available in the ecosystem, and the entire digital lending ecosystem also has been enabled by the regulators and the lenders of this country. So this kind of started post demonetization with the almost the which was mandated on the users to move to a digital payment interface, which is a mobile phone. So when we see the penetration of internet in the country, and if we go back 10 years or even 5 years, the penetration of internet was not what it is today, and it is being penetrated through the mobile phone. And what we are seeing, uh, the cost of the smartphones and the penetration of smartphones at a country level and at in the rural geographies, what the penetration has been. So it is both for the lenders, which is the convenience of lending digitally, which is friction free at a low cost, and for the borrowers as well, because now they always had the demand, but they have access to demand because the lenders are able to reach them digitally, and they are able to design products which can be sourced to the remote areas and at the ticket size which is palatable by the customers of those geographies. What we are seeing is, and the biggest impact has been with the unsecured loans, which is, and I'm considering consumer durables and two-wheelers as semi-unsecured or unsecured in the right spirit. And the impact is seen is the lower cost of acquisition because the customers are acquired digitally. The the opportunity or the business philosophy is no more hit and run or making one transaction viable, but it is looking at the overall lifetime value that you can achieve by acquiring customers. The social impact of this has been obviously going into the getting into the rural geographies, and also the aspirational youth of the country. They have access to small ticket loans even for the convenience needs. So the overall pie in India is about the 20 lakh crores is what is the pie of rural lending in the country. Where we see the inflection point, if you see the graph on the screen, the blue line is the growth of rural lending. As recently as 2017, this was growing at 3.5%. It from 2017 to 18 it grew at 10%, and as we speak it is growing at 15%. So what we are seeing since demonetization, so it is kind of completely aligning with demonetization, which is the end of 2016, and the numbers that we are seeing over here and the inflection point that we are seeing over here is starting 2017. Now, as I was speaking earlier, what we see is with personal loans and consumer durable loans, where the market share or the rural market share was insignificant in 2015-16, which was around 3% to 4%. What we are seeing, the same numbers have grown 4 times, to 11% and 8%, which is PL and consumer durables. What is also interesting is even if we go more recent and not go back 5 years, even 3 years back, it was 3% or 6% market share, which has increased to 11%, which is almost 4 times of what it was then. Two-wheelers, though on this graph, in terms of market share, we don't see a significant shift. But when I speak about two-wheelers specifically, we will be able to talk about how the rural market share in two-wheelers has shifted over the last 3 years. Yeah. So personal loans, what we used to see as, about 2 million customers acquired in the rural areas in 2017 and 18, that has become almost 10 million customers, or over 10 million customers who have been acquired in the rural geographies. The growth compared to last year has been 163%. What we also see is, if we go into the data, what is interesting is, who are these guys who are extending these personal loans in these areas? So apart from the usual suspects, which is the public sector banks, which have been always been there, and as far as their presence was concerned, we are seeing a very strong presence of consumer durable lenders cross-selling personal loans. And what is even more interesting to see is purely digital platforms who do not have any brick and mortar and people presence on the field. We see substantial loans being extended by them. We see at least 4 to 5 lenders, and it could be even higher, because in the fintech ecosystem, there could be one lender's balance sheet, which is, you can put multiple facades on top of that to have a digital interface for the customers. So we are seeing at least 3 to 4 large players who are extending personal loans in these geographies. What we've also seen is, as far as the product design, so though these are loans, the average ticket size of these loans are substantially lower than what we used to, what we have seen traditionally. And I'll go deeper into that. Two significant points over here. One is, the PL industry is more comfortable, or rather relatively more comfortable, lending to customers who are having a shorter vintage on the bureau, which we call as thin file customers, or even new to credit customers. So we are seeing more percentage of loans being extended to thin file customers and new to credit customers. What is significant here is, if you look at the average ticket size of personal loans in rural, which used to be around 200,000 rupees 1 year ago, or rather in 2018-19, came down to 1 lakh rupees, which is 99.9 thousand. So, and if we look at the data, and if anybody has looked at our recent report that we had published on personal loans, we are seeing that if we look at small ticket loans, which is sub 50,000, more than 50% of the sub 50,000 loans are sub 5,000 loans. What is also encouraging is that one would believe that this is resulting in higher BADs in the portfolio. But if we compare the performance of a rural customer with an urban customer, there is no significant difference in the performance of these portfolios if you compare to urban. So it is not that going rural has its side effects in terms of the poor portfolio performance. So consumer loans, which was, if you go back into 2000, even if you go back into 2016, 17, or rather from 15 and 16, we have seen there has been a year where it has grown more than 100% in the rural geography. And it is at an average growing at around 75%, being last year being an aberration. And why I'm saying that is an aberration, because something which was growing at an average of 70%, the last year or last financial year was not the most encouraging year from the lending perspective, but something which is growing at 70%, how come, we are seeing a growth of 20% there in rural? And if we look at the consumer durable growth year on year, which was above 35% for the last 4 years, how come that grew only by 2.7% in last financial year? So what we did is we went deeper into the data. We looked at the quarterly performance of consumer durable loans, and we looked at how that pans out with the behavior of consumer durable performance over the last 3 years or 4 years in terms of sourcing, in terms of the cyclical demand of each quarter, and also in terms of the total demand, in terms of number of units sourced. What we see is the last quarter of 2019-20, which is Jan, Feb, March, that had a significant dip in the supply of consumer durable, which used to be about 20 to 25% less than the third quarter. This was about 40 to 50% less than the third quarter that we witnessed in 2019-20. We could not figure out what resulted in this, so we spoke to some of our significant other major consumer durable lenders, and what they said is in the last quarter the stores stopped getting supply. And our hypothesis today for that is, this is an early COVID impact, which is not only visible in this financial year, but it is also visible in the last quarter of the previous financial year. So though the numbers are what they are, what we are kind of attributing this performance is to early COVID impact on the consumer durable portfolio. But if we take a step back, and this was kind of digressing from what the main objective of this discussion is. But what is the result? What has resulted in the sharp demand for consumer durable in the rural geographies, and even in urban for that matter, is the availability of reasonable mobile phones. It is the availability of low cost and affordable data, with the introduction of the new telecom providers, and also forcing the customers to go digital, through the payment facilitation. Again, like personal loans, we have seen that the lenders are relatively comfortable lending to customers who are new to credit and having lesser vintage on the bureau. And what we are seeing is, in terms of the performance of these balance sheets are performing as they are as good as the performance of the balance sheets in the urban geographies. Coming to two-wheelers, we are seeing that this has gone through a stressful period last year. However, speaking about the rural demand of two-wheelers, we are seeing that there has been what used to be the rural market share, which used to be about 30% around 2015-16, has become 42% in 19-20. And if we combine the market share of rural and semi-urban, which used to be 42% back in 2015-16, that has become around 56% in 2019-20. Though I would like to hear more on this later, hopefully, but what we understand is it is not a similar story to consumer durable. It is, but what we understand is the the OEMs or the manufacturers of two-wheelers, two-wheelers is more of a push and a pull product. So the OEMs push the products to the suppliers, and the suppliers have their own marketing strategy to push those products further to the customers. In the last quarter, though the sector was going through stress already, the manufacturers were not able to push the vehicles to the suppliers, and that is what has accelerated the decline of the business in the last financial year. As one would have realized, that we are following a few metrics for each product. For two-wheelers, continuously we see that there is a growth of customers who are having less than 12 months vintage, in rural and semi-urban geographies. And as far as the average ticket size increase is concerned, this is more of kind of a market driven. It is a need based product, and it is in line with inflation is what we have seen traditionally. In microfinance, where we used to see that the share of the microfinance portfolio used to be higher with urban, the microfinance institutions were extending loans to the urban poor more than what was being extended to the rural geographies. What we have seen of late, or rather the split was almost half and half since 2015, which was about 50%. Today the percentage is around 57% of the market share is of the rural sector in microfinance. And this, inflection is something that we have seen in 2016 and 17, wherein, we have seen that the demand for microfinance loans has increased in the rural, or the supply of microfinance loan has increased to the rural sector compared to the urban sector. So the rural microfinance market has grown over 3x over the last 5 years. What is significant here is that the average ticket size of microfinance, and the usual perception of people that microfinance loans are small ticket loans, they are. However, the average ticket size, which used to be 20,000, and if we even go back into history, which used to be 10,000, and it is steadily increasing, and today the average ticket size is 35,000. What is also not usually spoken about is that the JLG loans is a group loan. So the effort that the lenders are putting into underwriting these customers, it is not to underwrite a customer for 35,000 loan, but it is to underwrite a group for 3.5 lakh loans. So what this would have resulted in is that the cost of customer acquisition does not increase, because it is almost fixed cost, but the average ticket size has almost doubled, in the last 5 years. Microfinance is an interesting sector to observe and to take some cues from, in terms of, once you have acquired a customer, there is a template that we are seeing that these customers, can be cross-sold any other loans or retail asset. We are seeing today already 20% of the microfinance customers, they have a retail credit line on them. This is a function of some of the microfinance company institutions themselves being taken over by banks, and the banks have a larger portfolio of products, so they have cross-sold that to them. And what we are also seeing is the same customers are also credit worthy to be picked up by traditional retail lenders. So, and this number, which is 20% today, 3 years back that used to be 5%, and it is steadily increasing at the pace that we are already seeing it has increased in the last 3 years. So when we speak about digitization, it is not only the interfaces where the customers are interacting with the lenders, but it is the entire backend ecosystem which is available today. So the entire API ecosystem, which was kind of accessible by a few evolved lenders, today we are seeing that even smaller lenders are extremely comfortable in creating those backend integrations, whether it is to be able to do a video KYC, whether it is to create intuitive interfaces for the user through which they can interact with them, and the India stack ecosystem that is available to the lending ecosystem. So, that is it, from me. Over to you, Sucharita.
Thanks so much. Perhaps if you can stop sharing the screen, then we can see everybody. Thank you. Thank you, Vipul, for an excellent presentation. Welcome to all the panelists. Some of the points that at least really jumped out at me was one, digital lending is now an enormous asset class. We were discussing yesterday with Wilfred how it's really difficult to categorize digital lending, right? The credit bureaus, for example, don't know how the customer was originated. It could have been originated from a dealer, could have been originated by a smartphone. It's hard to know, but estimates are that across India, there's digital lending customer segment across all types of customers is about $150 billion. So this is big. It's really big and it's growing very fast. We also saw that in terms of future trends, Vipul told us that in the next 2 years, we're going to have 820 million smartphone users. So this clearly defines the growth path for this industry. And we also see that certain categories like small loans, personal loans, are growing at unprecedented rates. While industry is growing at 15-20%, personal loans is growing at 160%. This clearly means a lot. Not, overall, I think there are two sides to the coin. It's a huge opportunity, huge impact on, a customer segment in India, which is largely informal in nature. But yet again, whenever there is rapid growth, there is also the need to step back and see what makes for responsible growth. So I think we're going to talk about both of those directions in today's meeting. And with that, my first question is actually to Ranjan. Ranjan, you have been, undertaking a pretty ambitious digitization journey. And what's remarkable is that, NBFC MFI, the customer base that it caters to is actually, is low income, largely women, digitally actually less literate than other customer bases. I'm keen to see, with this, I would say, most challenging customer base, how have you gone through the process of digitization? How has it impacted product design as well as various lending processes in your experience?
Yeah, so thank you, Sucharita. Am I audible? Clear?
Yes, yes, absolutely.
Yeah. So thank you very much. Sucharita, 99% of our customers are women. So let's start from there. And most of our model till now is, digitally assisted model. As in, not every one of them have a smartphone. So therefore, it is incumbent on our field officers. We have about 3,500 of them who meet every customer every month to be able to use the digital, rather harness the strength of digitization. To be fair, so for us, it was more of a necessity rather than a choice. The main reason being the scale. See, we were about 10 states to begin with about a couple of years back, and by now we have got about 3 million customers. And as you know, microfinance is one of the most tightly regulated entities in the country. So we have got a margin cap on the rate of lending, and also we have an indebtedness cap on the customer. And so while those regulations are there on us to be able to seamlessly service the customer at the front end, it was a need to ensure everything is in order, at the same time keep OPEX under control. So if you are handling 3 million customers over a period of time and through 3,500 people, and the timing is also outstanding. I mean, this was a time when India Stack was taking its baby steps, and that is when we rode the wave and actually went into digitization. So today we have all our field officers, we call them customer service representatives, having a tab or a mobile phone to handle customers. Now, why digitization? See, very quickly, let me tell you what the processes are. So internal processes is your verification, group trainings, and after you disburse the loan, your repayments. And then you have, at the front end, you have to do your eKYC checks. You have to do your credit bureau checks. You have to do your internal credit rule checks. And finally, when the customer is ready to be onboarded after being approved, you will also have to do probably a penny testing on the bank account on which you want to disperse. Over a period of time, especially post demonetization, most of the large players have actually moved into almost 100% cashless on disbursements. I mean, to customers who hardly a couple of years back didn't have bank accounts, to be able to do that over a period of time and say that we are 100% cashless on the front end, you definitely need a digital infrastructure at the back end to able to support you with that. We were, so as I said, it was a conscious decision. We rode the wave of India Stack as it was developing over a period of time, and to encompass all of them to ensure that there was real-time servicing of the customer. There was workload reduction from a lot of paper to nearly paperless. We adopted digital, and today we are very happy that 100%, almost 100% of our customers are actually disbursed directly into the bank account with no cash intervention in terms of disbursement, which used to be the normal state of things in a microfinance space. So for us, I think it was a journey. We saw it coming consciously. The board was very supportive. The management team was very clear what was coming. Demonetization only accelerated it, but we were already on the way of doing that, and that's how it has been. And I will talk about it further. There are other things with respect to probably as we go forward in this discussion. There is customer protection, credit 360. There are a lot of other things which have to be spoken. But I think it's premature to talk about it. But I think digitization for us was the only way forward, and we took it. We took the right call. We are happy that we are in a stage where we have enough, base and a structure to grow on it.
Thanks so much, Ranjan. So Ranjan says digitalization in lending is an imperative. It's not a choice, it's an imperative. Opening this up also to Vishal and Ajay. So you also, both of you run very large franchises, right? Very large institutions, incumbent institutions, and also deal largely with the informal sector market. My question is, while number of smartphones is going up to 800 million, although I still have a question of what is the number of unique users there. I believe the number is a bit lower. But putting that to one side, do you think that along with digitization, assistance is still required for the customer. Ajay, you have an enviable, dealer franchise, which in effect is a point of assistance. It's also a point of discovery. Vishal, you have very large microfinance operations as well, which has assistance built in to the core of its operations. How do you think this assistance changes as we go along in this process of digitalization?
Ajay, you want to go first?
Yeah, thank you so much. It was 2013 when we decided to enter this two-wheeler space. We were on a pen and paper. The customer walks in, he has to write down application form. And when we say we wanted to do it with pen and paper and we will digitally onboard customers, the guy who actually contact with the customer, we see a huge resistance. He says, sir, how can this be possible? It will take too much of time. But at that point of time, when we are discussing and trying and convincing and training people towards that, I think that point of time, this word has really helped me to, convince people it's not the digital, it's a phygital. So we will do some part digitally, some part physically. And over a period of time, when we observe at some point of time in festival time, we see when the system is not taking that kind of load, and we push people, okay, system will reboot in some point of time, you go ahead and do this processing manually. I got a pushback. He says, no, we will wait for 5-10 minutes. I think the ease which team within the Hero FinCorp and the real customer has experienced, that has really given us mileage to take that bold decision moving away from pen and paper as 2013. Over a period of time, we have seen the environment changes dramatically. Now we used to install the PC at the dealer's table. Now we have moved away from that. Now it's app-based things. So it has really helped us to onboard customers as seamlessly as possible. So that was a great journey for us. One of the most important thing, even the customer's attitude towards the whole changes, moving from physical to kind of a digital wave, their cooperation is also needed. And when you're talking about the rural story, we are covering almost 21,000 pin code. And when we go to the smallest location, I've seen the guy who is walking in the dealership to buy one of the product, carrying a smart phone, which is larger than our normal phone. So this clearly shows the adaptability of that. And that has given us a strength and, the power to, push the digital agenda to the extent. The digital percentage is now increasing, physical percentage is going reducing. But I still believe that it will still take another few years to go complete digital, because there are certain regulatory challenges also we are facing. But it's a good start, and I think in over a period of time, in next 2 to 3 years, I see remarkable changes will happen in terms of customer onboarding, particularly towards the business which we are in. Vishal.
Yeah,
Thank you so much.
Couldn't agree more with Ajay or Ranjan. I don't think digital, we have a choice. It's a necessity for us to really grow our business and take it to the next level. So for us, the inflection point really came, and we learned through a lot through crisis, that in terms of when demonetization happened, we realized that this paper-based sourcing across our 3 million customers, topping the loans up to them, will not really take us to the next level. So what we did, we understood that you have to reimagine the consumer journey, simplify the onboarding. And how do you simplify onboarding? When the customer wants an end-to-end frictionless experience, and that experience should be such that he feels very happy about the whole journey of getting him onboarded into our company or getting him an existing borrower a new loan. And that's where we realize that without a tap sourcing, we will not do a single onboarding for any of our customers. And we also figured out that it is any sourcing we do for any product, because being an NBFC, we are not only into JLG or group loans lending, we had individual loans, personal loans, two-wheeler, and LAP. We realized that any decision point of whether to grant a loan or not has to be completely digital. And then end-to-end this journey from a customer experience to grant a loan could be digital, is what Ajay said. So decision point, at least embark on a journey where you give him a decision point digitally, then in there with a 30-40 minutes of application, and then let that journey finish. And that could take a digital experience. Also, what we did was we started driving personalization. I don't think one size fits everybody, and that also with the right kind of data entry through tabs, through our applications, helped us to do checks and controls, validations, get a better source of data initially, and with the help of analytics and data outputs, we got better set of customers to service them and also to upsell and cross sell. So that was the other big advantage if you go through digital, and that's what we realized in the last 3-4 years or so. And then I believe there's a big organization cultural change. I think, whatever we do digitally, the whole organization as such came in to adopt the technology. I think the powerhouse have changed from an operations to a technology and automation world. I think in every company, I think a technology setup is becoming far more prominent than an operations processing setup. And that culture change also took place. So pretty much same kind of a journey we had on the rural. As a rule today, as an organization, we don't onboard any customer without an app or a tab. So there are no physical paper across all our customers, be it a new set of customer or an existing borrower. We always go with tap or a tab-based sourcing, and decision point has to be digitally derived at is the mantra for our organization.
No, thanks so much, Vishal. I think you touched upon a number of important points, including ease of onboarding for the customer, plus cross-sell and upsell, personalization, mass personalization of financial services is now possible, which was earlier just not possible, and not just in loans, but also spanning loans, insurance, savings, because at the end of the day, customer needs all of these products, right, to actually achieve their life goals. I want to talk a little bit more about one point that you touched upon, which is the role of digitalization in underwriting. And Wilfred, question to you. I know you're helping many institutions achieve this. What are your experiences in implementing digital underwriting projects?
Thanks for that, Sucharita. We heard about the entire process of digitalization where it is becoming important as well as it is giving a seamless experience to the customer. Now, the seamless experience could be coming on sourcing a customer, but the seamless experience will be complete if you're also able to give your decision, give your disbursements, everything seamless, but also keeping your risk in mind, which is where the underwriting comes in. So as a company, we have been providing services around data, around analytics, as well as around software solutions to have the enablement across for any client to go digital. So in our experiences, what we have seen is there's a lot that has happened over the last, let's say, I would say a couple of years, where lenders have gone into looking at automated decisioning. So using some of the solutions, etc., where a lot of data is available right now. So while credit bureau is one part of the data, but there are many other data points which lenders are tapping into. Some call it alternate data, some call it something which is going on field, phygital, as Ajay mentioned, as well as Vishal mentioned. In some segments, a field visit is required, but how do you use that data? And then having models around usage of the entire data parts. So that openness we are seeing from a lot of lenders. I would say the type of products on which a lot of our clients have worked with us to build models vary from the traditional personal loans, vary from the traditional credit cards, etc., to even rural business loans, JLG portfolios, affordable housing, normal housing finance loans, which normally you would not have looked at from a digital or a automated decisioning point of view. And that is one big change that we are seeing all across. Just one more point on this I would add is a lot of openness coming in for underwriting a new to credit customers. And And that is what we saw in Vipul's portfolio, in Vipul's presentation also. And for that, again, people are opening up in terms of looking at some scorecard models where you can run something on a new to credit customer using maybe psychometric, using maybe any other alternate data which is available, but a lot of openness that has come for the new to credit customers. So we are seeing that trend right now.
Right. And again, question, really to the full group, as practitioners, and Wilfred, Vipul, to you as well, given that you have all of the information about this, how successful have these underwriting models been? I know that there are a very wide variety of underwriting models, ranging from rule-based to scoring models to deep learning models. What are the kind of models that you're seeing, and how successful have they been when you compare it to the old world way of physically touching the customer, evaluating the customer, depending on your staff's judgment and data that they have collected? How have you seen this evolving?
So I'll take a quick stab at it, but I will actually leave it to the practitioners who have been using such models. But see, for any model to work, it has to go through a cycle, right? And that is where we have seen good amount of benefits in some of the models that have been prepared for various portfolios. It also undergoes a normal process, and that we recommend to most of the clients, is to monitor the model or the rule-based underwriting that you're having, but keep on monitoring it at a very regular interval, because as we have seen, things have changed and things are changing fast. Your sourcing portfolio may change, so the way you are sourcing, the type of profile you're sourcing, if those changes are happened, those things have to be incorporated in your underwriting model. So monitoring there becomes more and more important, and that's people who have gone into that route have seen benefits of the portfolio that has come in through a model as well as being monitored. And I'll leave it to Ranjan, Ajay, and Vishal to talk more about it in terms of the model.
Just wanted to make one comment. I think this has a lot of power because you can bring so many new customers into the fold, and there is still huge space to grow. Which is why I know, even though these are early days, I'm asking the question around how successful have they been, because if it is successful already showing, then the world is our oyster, literally.
See, the biggest advantage which this has offered us, earlier the business policy and credit policy used to run parallel. Because in business, what works in Punjab, the same thing cannot work in Tamil Nadu. But unfortunately, when we were in the erstwhile underwriting policy, we used to have one single policy which fits to all, which also referred by Vishal in his opening remark. But now this model has given us, we can run 100 policies depending on the location data available, dealer data available, city data available. So this is complementing the business, which is expanding new territories, new markets, which we are not in a position at that point of time. And most importantly, there has come a predictability. We are not depending on individual perceptions about how the policy has been perceived by that individual. Because when you keep two underwriters together and ask to underwrite the same case, probably you will see two different opinions about it, because each individual perception about risk is different. But when you are moving towards the data-backed analytical underwriting piece, you have there is a data decision, there is no biases, and most is it comes predictability. Which data point has worked for you, which is not worked for you, you have ability to analyze and change on the go. So I think it's clearly showing us results. Because we are now on the score-based underwriting for even two-wheeler and for personal loan, which is clearly given us that mileage. So I'm pretty sure it will further get enhanced with the more data available. I think importantly, what's happening is people are also now seeking more data. At one point of time, there was only 10, 12 pointers were available. But today, everyone is looking for that alternative data points. What else I can bring in, which fine tune the model further, and the champion challenger can be created.
Thank you so much. I think Ranjan has a point, right?
Yeah, just to add to what Ajay said, I think absolutely, I completely agree with Ajay. One, it takes away any biases whatsoever. It allows you to have rules at a pin code level if you really want to do it that way. But what it also gives you is that over a period of time, when you are using these models, every case that flows through that model leaves a footprint. In a footprint of a probability of default, it gives you a footprint of what was it at the point of sourcing. That for future gives you a big input for your future analytics and decision making. That is one. The second point, very important point, is that when you are using such a model, you are basically, so it is not probably so relevant for me as and in microfinance, but it opens up a position for you to do risk-based pricing of customers. Today, most of the places, I know for sure, at least for the microfinance space, I can tell you, risk-based pricing is not something that is practiced. As we believe that microfinance will probably evolve into microcredit, people who are actually using these routes of models and rules will be far better positioned to harness the data that they have, the analytics from it, and price the loans accordingly when you're really looking at a microcredit. So there are much other advantages if you are using models in the future. It's an ecosystem that you are growing. And for microfinance especially, we can tell you data is not an issue. We have got large sums of data, being the portfolio being so granular. Data actually works in your favor. So people who are investing in this, people who are having this kind of data and analytics and footprints of the previous data, I think would be at a much more advantageous position going forward.
Yeah, I actually always wonder why people talk about alternate data when actually the traditional transactions data continues to be the most predictive. And we have tons of it that's not being utilized. So
yes, underutilized. Underutilized.
Completely underutilized, right? I mean, first let's go cover the 95% and then go to the, okay, how can I get 5% better? Yeah. Vishal, your thoughts?
My thoughts would be, if I would just add up to what Ajay and Rajan said, it's also important to marry some of these data points, like a bureau data to a data from what we do as a behavioral score, and then we have tie-ups with some of these players like yours, where we do a fintech vis-a-vis tying up with our NBFC setup, which helps us and enable us to partner and get guarantor scores, behavioral score, bureau data all married into one, and then move from a business rule engine to a scorecard methodology so that we really look at alternate data alongside uh, our transactional data, and then give a pre-approved offer or a cross-sell or a top-up offer. What we have 3 million customers, and most of our panelists out here have big database of current customers, and what each one of us did during the pandemic time. We did a lot of play on our data to ensure that we top up our existing borrowers. And though Wilfred is right that a lot of things have changed over a period of time in terms of granting loans to new customers, but in these times of crisis, most of our financiers were just looking at getting alternate data of our own existing borrower and giving them pre-approved offers. And each one of us, and companies have thrived out of that, right? It's low cost of acquisition, it's data study at your own end, complemented by partners like yours. And there is so much of e-commerce partnership happening with finance lenders, and also two lenders partnering as a blockchain. So that's going to be the future as well. You will have to keep your data enriched, get it at the next level of giving top up loans at times of such kinds, and going forward also upselling or giving a cross selling data. Like what we do today is, for our group loan we move them to an individual loan, and we give them same set of most of the same set of customers a lap loan. Some of our customers have stayed with us for good 12 years, and they would have started with a 20,000 loan, and today they are carrying a lap loan of 10 lakh rupees or 15 lakh rupees. So I would say that marrying of alternate data alongside your own bureau data and your own behavioral and transaction data is the way to go.
Right. And what I'm hearing from all of you is that this is working, right? It's not like this is in the experimental stage. We still need to, evolve the models before it actually goes into production. It is already working right now. So this is actually, honestly, music to my ears, and also fantastic for social and business impact. Because to my mind, I feel that one of the key drivers of social impact is empowerment. And I've always had this question, especially for microfinance, that today we expect a woman customer to form a group, go through the rigmarole, meet several times in a month, or maybe once a month at least, to get a loan, while she has years and years of track record. When do we see the shift to being, let's say, majority individual lending, where customer is empowered to borrow on her own? Because to me, that is true impact, right? This is convenience to the customer at its highest. Somebody like Ajay is already there. But how do you see it evolving in this microfinance space?
I'll go for that first, Sucharita.
Sure.
Sure.
Yeah. So, okay. So frankly speaking, 50% of the customers are already individuals in that sense. They're not part of a JLG as such. But then the other part that you said that, customers have to come to a center, that's a different thing. It's about a behavior. It's about, I mean, that's one of the reasons that brings economies of scale to microfinance. Unless you are getting a lot of customers where the ticket sizes are comparatively lower, 50,000 odd max, or max up to a lakh of rupees, unless you have a lot of customers together in a center, it will not be viable from an operational expenses point of view to be able to run the business. However, having said that, there is already enough discussions, and at least I can tell you in our company, in our own, I can tell you, we are thinking of the customers who are 3, 4, 5th cycle customers, been with us for a longer period of time. Ultimately, it will actually metamorphose into a low touch model wherein it's completely digital. A lot of these customers are actually using smartphones. Their children, their daughters, their daughter-in-laws, they are using smartphones. So as we believe that over a period of time, this is not happening right away, but yes, it is going to happen when you will see a significant portion of your existing customers are low touch. They are able to access even microfinance loans, even in the rural areas, at a touch of a button. And therefore, to that extent, I do see it going forward. But if you really ask me, is the ecosystem ready for that kind of a situation today? I don't think we have some way to go towards that, but it's definitely in the horizon that I can tell you about.
Also, I'll just add on to this, Charita. We saw in the presentation that there are 20% of the microfinance customers actually today hold a individual loan, a normal retail loan of various types, right? And this was, again, as Vipul said, this was less than 5%, let's say 4 to 5 years back, and it is growing by the day. So the capability that is being built to a microfinance borrower to actually become an individual borrower is already happening today.
Yeah.
And the ticket sizes are also not very different compared to a consumer durable loan versus a microfinance loan today. So I think the other discussions that we keep having with clients is actually to try to underwrite a customer as a customer rather than underwriting them for a particular product. So a line underwriting for a customer versus a product underwriting. And I think that's the way more and more of such customers would be qualifying, or maybe for the lack of a better word, qualifying as a individual borrower per se.
I go with what Ranjan has said, that once you move group loans to the individual loan, the per loan profitability is also one big question mark which comes to the lender. And I'm bringing a very different thought here, because all these large microfinance companies become either a small finance bank. The delta of data which was available with them, they could not convert that customers to their individual borrowers today. And the biggest challenge is this, because at the ticket size they were playing, and once they become an individual borrower, your scale of economic benefit does not come to the lender. For a doing 10,000 rupees loan, all of a sudden neither borrower becomes eligible for a 50 or a 1 lakh rupee loan. Even if so, then there are other risks attached. So I think we are in a still a very nascent stage in terms of moving towards that direction. And this really always, I say, if they have so much of a data, why those group borrowers are not getting converted into individual borrower? And when you go down micro, then you realize, okay, these are the challenges. Until unless you have some solution to it, I think we will not able to mint that gold mine.
No, let me just add one more point here. I missed out during when I was saying. See, in the typicality of microfinances, every year we've seen with bureau data is that with CRIF data, we've seen that almost 20-25% microfinance customers actually drop out every year. And to the point which Ajay made is that there are some customers who are actually becoming microfinance plus, where these were customers who were ready on a plate to you. I'm excluding the ones which are delinquent. I'm just saying ready good customers who were there and suddenly they went off the radar of microfinance. But when you are actually seeing them on a bureau with that overlap that Wilfred said, we have seen it grow from 5% to 10% to now 20%, which essentially means that you have customers who have moved into the retail segment, and yet because of regulation, because of whatever other, I agree with Ajay. I don't want to comment on why they couldn't convert, but definitely there is an issue that they couldn't get converted into those customer segments that they want to be. There's one more aspect I want to bring into here. While we are talking it from our point of view, ultimately it is we are talking of social impact here, right? And in the same breath, we will also have to speak about customer protection. Microfinance being so we are quite used to it because we are regulated. Our customers cannot have an indebtedness more than 1.25 lakhs. But on an overall basis, wherever there have been financial crises in the microfinance segment, it has always been one or two major players going overboard and lending more than what the customer actually can absorb. So to that extent, unless now a lot of players are using Wilfred's Credit 360, where you are not only pinging the microfinance bureau, but you're also using the retail bureau together and see the overall indebtedness. So while we are talking from our point of view, I think customer protection also becomes this digital journey of assimilation of the digital footprint, along with utilizing those digital tools that are available like a Credit 360 on the ping at the point of sourcing in front of the customer. I think protects both the lenders as well as protects the customer in terms of not getting into the indebtedness trap, which have always been one of the key reasons for social disturbances in the history of microfinance.
Yeah. No, very good point.
To what Ranjan and Ajay said, I think there are two phases to really get an individual borrower, base of pyramid women borrower, to get a loan at an individual level. Technology advancement is one, which every organization, I believe, is working in terms of and wanting to give them loan. We all of us want to give them loan, and all of us are ensuring that the technology is ready. So what is going to help? A digital end-to-end journey, video KYCs, machine learning, big data at our end. It will help us to give accurate credit risk profiling and also give the loan to them in a very easy, convenient, seamless manner. And it will be cheap to them. What is the problem which the customer faces today? We will not be able to collect like the way we do collections from them on a monthly basis from a JLG customer. We have to go to door to door each month and get payments in cash from them. Now these customers who have got Jan Dhan accounts, most of them do not want to keep cash in their bank, and they do not give us NASH. If I don't do a monthly presentation and I do door to door collection every month spread across the pin codes, this will never be a feasible win-win for both customer and us. So these two phases, the ecosystem being ready, and I'm sure in times to come, this would get ready. I think the organizations are doing their bit to get the transformation on technology advancement done so that the customer as soon as they're ready to keep their bank accounts funded. And that's the reason what Ajay had raised the point, why are these microfinance companies moving to SFBs? They are getting their deposit or savings bank account also fulfilled at the time of origination of a loan. Okay, so that sooner or later would help all our base of pyramid customers, women borrowers, to get an individual loan. We are striving and wanting to do that in a big way. Our success have been there to some extent. We would really like to raise the bar and make many of our customers cycle 3, cycle 4, cycle 5 individual loan customers as well. But the customer win is still a little away from what the current scenario is.
Thank you so much. You know, I'm conscious of time. Just want to encourage the audience to ask their questions around now. Please start sending your questions through on chat as we go into the concluding part of this discussion. So just coming back to the discussion, Vishal, thanks, all very good points. I think what's very clear is that even today, like Wilfred and Vipul both said, there are microfinance customers who are going into the retail finance space. And at the end of the day, customer retention itself is going to become a huge imperative. And therefore, shifting these customers to individual lending so that, also they don't go out of the system, right? Attrition is also there for a reason. It could be one of the solutions to both handling the attrition as well as taking these customers into the digital space. I think into the individual space. I think one of the things that you talked about was, the cash collection versus digital payment, and that's a tough one. I think there are no very easy solutions to this. I know that post in the pandemic, the good news is that there has been a lot of innovation around this front because, again, it was a necessity. Necessity is the mother of invention. So, all companies had to. And I think that there are a few headwinds in this direction. However, do feel that the cash in, cash out network fundamentally will need to improve. The BC network fundamentally will need to improve to get there. So there is a little bit of an ecosystem shift that's required. One, probably concluding question to the panelists is, do you see competition from the digital platforms affecting your business? Today, honestly, in numbers, there are many, right? I'm not going to list names, but the usual suspects that are out there. Large part of the personal growth in personal loans has been driven by these, direct-to-customer digital lending platforms. Do you see these as threats to your business, competitive threats to your business, and how are you handling this?
We really don't see these digital platforms are really going to pose a threat to us in terms of our growth trajectory. The one of the biggest reason which I have observed is they might be a very good in terms of customer onboarding, but their ability to collect is question mark. The kind of intelligence they might have put in to onboard customer absolutely seamlessly, I don't think they have put in even 10% of that intelligence in collections, because traditionally, and the kind of customers which we are onboarding, they are onboarding largely NTC. They have to go knock on the door and then collect the money. Yes, there could be some portion of digital movement which is happening, could have happened, but it's a long way for them to go and devise the same kind of technology in terms of collections. Otherwise, you can have a very high rate and distribute loan to everyone and then see what happens. But I don't see they are going to give a competition till the time they are not harness the art of collections. And on the digital side, I think we as a group and as an industry also, we haven't made that kind of headway in terms of sophistication of collection or more analytics on a collection or digitization of collection. I think everyone is talking about the customer onboarding seamlessly, but the fructification of the per loan profit will only come when I'm able to collect the money, and the cost of collection is always a major pain area for every organization. So I think this also is very important criteria. If it's something needs to happen on the good scale of analytical digitization in collection space. Till the time, I don't see this digital player will play any significant competition role with all the big NBFCs.
Yeah, so Sucharita, from my side, I think let me share with you. I think what Ajay said actually had a glaring, examples, especially during the pandemic. You know, people who did not have feet on the street and the wherewithal to actually connect to customers and able to collect the money had a really difficult time. And until the time that we are phygital, to go back to that word, I think it is very, very important that we have to have that connect, which the fintechs will not have in the at least in the medium term. That what I can see. Having said that, while there is no direct competition, but there is significant amount of adoption of those fintech, the tools of the fintechs, not only with us but almost all players. So while they may not be direct competition, there is no harm in actually taking the good things that have come, the innovations that have come from there, and implement it. I mean, I'm not really overtly worried about competition, given the connect that I have with my customers. Every month, 3 million customers I'm tapping. So I don't think there is a competition. But at the same time, if we are sleeping and not rising to the hour and the changes that are happening and not adopting the fintech advantages that are there, I think it would be wrong on our part. So we are adopting it. We are moving forward. But competition right away, I don't think so.
So you're basically saying take what is good, and but you have a significant edge on the touch and the collections.
Absolutely, absolutely.
See, for Sucharita, for us, we have four businesses arms: urban, rural, digital. In any ways, is a separate arm for us, and we don't do it as a platform business. It's a business in itself. So my guess is fintech players will have a role to play. However, like fintech is good in technology. They are good in terms of getting advancement, in terms of getting customers onboarded. There is a big customer cycle in which they still have a lot of things to learn. The servicing part, getting the credit and risk, learning, which Wilfred also spoke about. You may have a scorecard which works very well for some period of time, but if you don't monitor it well, then that scorecard would not be reaping you results forever, right? So my point is, for fintech, there is more to learn. For players of finances, pure finances of rural businesses, we also have our share to learn from the fintech and lending platform companies. So I think both of us will definitely exist. Market is big in any ways. And if you speak of rural, I think we have not even scratched 1/3 of the total consumer requirement of credit today, as per bureau data of Wilfred goes. So there's a big market in any ways. I think both of us will have to learn from each other in terms of things
Very
which
valid.
we share in space. I think we'll have a lesser to learn and lesser to adopt compared to a digital space player, because I think there is a people connect which Ranjan spoke, and I think that is going to continue in one way or the other. And my guess is it will always be one touch digital. It could very difficult in a country of ours to be completely digital. I think neither the financer or the consumer would feel comfortable without even one touch to either grant a loan or to take a loan.
Correct. Actually, if you study the Kenyan market, because of the proliferation of digital lending platforms, something like 85% of customers have got a negative bureau record for small loans, like of the size of 300, 400, 500 rupees, because these were all done through mobile players, and which is a huge customer protection failure. At the end of the day, you put 80-90% customers out of the market. That's not great for anybody. Even in India, we've had concerns. Recently, RBI set up a working group to monitor practices of digital lending platforms. What do you think needs to be done for responsible growth so that we can actually create social impact?
Let me first speak about the microfinance industry. I think we are through the SRO, we are actively talking to the regulator on having rather than having a regulation based on entity, let the regulation be on the segment, which is microfinance, which is one of the reasons that microfinance will have a healthy growth going forward. So one, the regulation needs to be tweaked in a sense that it facilitates growth, at the same time addresses what you rightly pointed out on the customer protection. Because we don't want to go the Kenyan way, classic example that you gave, that we have a trail of bad credit bureau records. That is not the idea. Rather, we want a healthy growth of the industry, wherein and thanks to RBI that we have those tight microfinance norms, and they have done the test of time. But as to take Vishal's point and Ajay's point, models are good, but unless you are able to tweak those models in terms of the change of the economic scenario, the current development, or the challenges that we have, it becomes stale and it can be counterproductive and have complexities. To that extent, I think over a period of time, we need to change with time and have the things, I would not say suited to the time, but definitely from a regulatory point of view, the regulator is taking the right step forward. I think the working group should have been there already. Better late than never. And I think there is enough inputs being given, and good that it has been taken up. And if the inputs are taken, I think fintech should not be killed. Otherwise, you will kill innovation. So therefore, it is.
No, absolutely.
Yeah.
And I do think that, microfinance is such a great example of self-regulation as well. And I think that could be a model for, the fintech players as well to really go into self-regulation. So there are 10 minutes left. Thank you so much for the engaging discussion. We have a number of audience questions. First question is, any thoughts on digitizing collections, which is the major challenge in hand? Anybody who would like to?
On the collection piece, one of the biggest challenge in the erstwhile era is that receipt issuance. We used to do a manual receipting, and over a period of time, we all have observed that they are fraud prone. Once you go deeper into the territories, I think the digitization has helped us on the digital receipts, and that has given us a huge amount of data points. Because at the end of the day, at any point of time throughout the day, if you have that system in place, you know how many receipts you have cut, who has cut, these receipts belongs to which bucket. So all those pointers are coming. Now it's up to our intelligent unit at your organization or the other player who are interested to do that, can really build a model around it. And this data is available. Field allocation, we used to send a huge files to the agencies for allocation. Today, this case allocation is going as granular as to the last mile of agency collector. His behavior is also getting captured while he wanted to do an analysis. So I think there are enough and more data points, but the amount of energy each fintech player or all the analytical firms are putting on the customer onboarding, if I'm saying if even 50-60% has been put in on this side, because this data is absolutely critical, and this will also give you enough data points to fine tune your customer onboarding or customer approval data points. So I think it's one has to start with these are the smaller steps, and over a period of time there are enough data points are available to fine tune your predictive collection model, to be very honest. And this has a huge bearing on the cost of collections. And particularly Ranjan and Vishal will aware that the kind of money we pay to the agencies to go and knock the door and collect the money, it really adds tremendous value. So if my onboarding cost is getting reduced by, if let's say 70%, even 20% reduction comes in the collection cost, the color of the balance sheet will definitely is going to look much better. So I think
the cost of collections in some way or the other hits the customer. See, what is
Yeah.
also happening is with the government also utilizing the technology initiatives are coming up with everything, right? They have BEAM, they have got Aadhaar enabled pay system. So technology infrastructure is built to pay through digital modes. Okay, you have wallets for everything now being, given to every organization for them to collect. The question remains the same. The Jan Dhan accounts or bank accounts have to be funded. The day they are funded, and it's
exactly.
not the customer's problem also. He needs to get the money digitally of whatever he earns. He gets the money in large numbers. He pays out you also in cash in large numbers. The day the customer himself gets all his revenue receipts, his earnings in through digitally, this is going to be a seamless journey for collection, and that's the end of the whole thing. India still remains a pretty cash economy, though the numbers would be slowly subsiding, coming down year on year, but still we are a large cash economy.
Yeah.
Correct. I'll just make a small point on this. As Vishal rightly pointed out, and Ajay had mentioned this earlier, there is still going to be cash collections as far as the collection part of it is concerned. So when we talk about digitization, I think there, Ajay mentioned a lot about improving the efficiency of your collection process, and those data points being used into models and using technology of your collection workflow and putting all of this together. If you can segment customers and then try to uh, prioritize your effort behind customers which needs field collection or where the customer can pay on their own and stuff like that, that will enable you to reduce your collection cost over a period of time. I think that is the way to go as of today, because cash is not going anywhere immediately.
No. I think we are digital payment is one area, but we are using a word touch free.
Yeah.
If customer himself can walk in to all these BC networks of banks or payment banks, that will also help in a big way.
Correct.
Because as Vishal said, that if there is no money in his account, he can't do any digital transaction. But if he is very happy to walk 500 meters closer to his house or shop and deposit that amount, and we built that infrastructure digitally connected, so he can walk, we can feed him information that go 500 meters left on your house and deposit money and you are getting receipts, etc. I think that is going to help, but it's still in process. We are trying to do. We are using our distribution network. We are also using these BC partners, but pushing customer to that is also a challenge in hand.
Big challenge.
Yeah. Okay, we have a few more audience questions. So I'm going to switch to the next question. One question from the audience is around in the overall ecosystem, who is actually responsible for building client awareness and financial literacy?
No, I think I can speak for the microfinance segment. I think it's completely upon us players. And I think whether through the SRO or the individual players, there's been a significant amount of thrust in ensuring that client literacy is one of the key reasons. I mean, the key drivers in terms of the success of the company. You see, one is that we meet at least. I mean, there are weekly models, fortnightly models, but for us in R1, it's a monthly model. And one of the key drives that we have always taken is client literacy. Very important from the point of view that the customers don't get into into over indebtedness. Second, don't get into frauds. Third, don't get into the clutch of money lenders or what we call pipeliners. Basically, people who are going to take your money and give it to somebody else. So those kind of things are very, very important for us for the protection, given the social sector that we work in. And we believe, at least in the microfinance space, it thoroughly and entirely upon the player, upon us. That's how has been our thought process.
I beg to differ a bit here. I think this government's initiative is equally important. And I think they have done a reasonably good job in getting that Digi Dhan Mela across the country. And they have been helping a lot of these, customers understanding on digital financial literacy in downloading, installing, utilizing various digital platforms. So I would say It's both private players as well as the government together partnering to get everybody accustomed to the usage of digital, and that will happen through a lot of financial literacy workshop. I think Ranjan is right, according to me, to a large extent, with we playing our part as a financer. And I think government has done reasonably well in also participating. Otherwise, that whole Atmanirbhar vision will not be there. We have to be inclusive. The government has to play its part. I think we'll have to be partnering with them and also play our part. So it has to be a private public partnership to get this whole of our rural, urban, semi-urban, everybody trained. Even in urban today, there is a big digital gap. Please understand, the entire urban does not use digital in the manner which we think so. And similarly, it's not that the rural doesn't do digital usage in the manner we assume so. So if you see the number of digital transactions which happened during the crisis of pandemic, in the first 2 months, we did 10% of our collections sitting from our homes, right? And it was rural collections.
Yeah.
I think we should not assume. I think the partnership of government and the private players will play and mark its part, I would say.
Yeah, I think as a financer, responsible lending approach has to be there. So particularly from my side, we onboarded almost 60-70% NTC customer, and in the smaller villages. So we tried this event. We used to call all old customers into a hall or some kind of pandal, and used to give them the credit understanding in partnership with the bureaus. It has given a good amount of response from the team, but it has to be on a very continuous basis. And if as a community, as a financiers community, if we can partner each other along with obviously the government, I think the impact can be really larger, because it is at the end of the day, it is benefiting to everyone, as an financer, as a customer, and obviously as a government will also get benefit out of it. But yes, I think as a responsible lender, one needs to put this kind of activities also to ensure that these customers really come up and understand the impact.
Great. We are officially out of time now. Thanks so much, Ranjan, Ajay, Vishal, Vipul, Wilfred, for a fascinating discussion. I think so many great points came out, both of public-private partnership, as well as the principles of responsible finance being applied into digital lending to create the maximum impact. I, for one, am really looking forward to the future to see how we can deliver a better customer experience. Thank you so much again.
Thank you.
Thank you.
Thank you, Charita.
Thanks, Vishal.
Thank you.
Bye.
Thank you, everyone. Bye-bye.
Thank you. Bye-bye.
Thank you, panelists. My special thanks to Sucharita for keeping the session on track. The session was quite insightful, and we have, in fact, more questions flowing in from the audience. I'll request the audience to feel free to connect with our panelists in the networking lounge and discuss your thoughts on the same. Thank you so much. Thanks a lot, everyone. We'll now reconvene in Hall A for the next plenary titled Small Finance Bank Delivering on the Financial Inclusion Agenda.
Thank you, Kirti.